Hello, everyone. Good morning. Thank you for joining us this morning. My name is Afshan Patel. I'm the Deputy Head of Asia Equity Sales at Morgan Stanley, based in Singapore. Before I continue, just need to remind everybody that please note that this event is for Morgan Stanley institutional clients and financial advisors only. The event is not for members of press. If you are a member of the press, please disconnect and reach out separately. Now that that's out of the way, thank you for joining us and welcome to our webcast today. The aim today is to share thoughts post-Liberation Day. And just a reminder before we go on to our speakers, if you have any questions, please type them in the Ask a Question box on your screen. So we will start with my colleague Arianna Salvatore from our U.S. Public Policy Strategist team. Arianna, Liberation Day was more hawkish than expected. I guess let's start with what do you think sums up sort of majority of the investors' views going into it, and what are your thoughts now on how this may play out?
Yeah, thank you so much for having me. Look, heading into Liberation Day, April 2nd, we really had two key questions that we felt were kind of reflective of what investors wanted to learn. So the first was, is this event going to provide somewhat of a clearing event for trade policy uncertainty? So in other words, trade policy uncertainty has been what's been weighing on markets for so long and sort of on the economic outlook as well. Investors were somewhat looking for April 2nd to be a moment of clarity maybe on the path forward. So our view was that we weren't going to get substantial clarity. I think that's pretty much what we saw. We saw the administration signal that it's willing to do bilateral negotiations. To what Secretary Bessent said last night, they are viewing these starting tariffs as a cap that can then go lower, which is in line with our expectation. Like I said, that it would be maximal a starting point for negotiations. But importantly, there's a pretty big caveat there, which is that if our trading partners choose to retaliate, those rates can obviously go higher. So we didn't answer much on the clarity side. And then the second question is, will these rates be high enough for our economists to have to revise down their growth expectations? And what we saw there was that our economists wrote these kind of make the range of outcomes skewed to the downside. It's really going to be a function of how long these tariffs are in place and how broad they are in nature. But what we saw last night was enough for them to remove the one Fed cut that they had in their baseline for this year and kind of push it into next year. So that's sort of how we answered those two questions in the wake of the announcements yesterday. I think now the real question is going to be on what is the path forward for these negotiations on a bilateral basis. And to answer that question, we're really looking at, first of all, the speed with which these negotiations can occur. And secondly, if our trading partners are going to retaliate. So on the speed point, this is procedurally going to take some time. If we want to have bilateral negotiations with all of our trading partners, there's going to have to be some prioritization. Our sense is that, the countries that initially said they wanted to negotiate and open up the door, even the ones before April 2nd, like Brazil or India or the EU even, will be better suited to kind of start off these negotiations, whereas other countries that are either retaliating, which we haven't seen much of yet, to be fair, but not really commenting or holding their cards close to their chest, we think that takes longer, and they're at a much more difficult starting point for these talks. And then the second component that I mentioned is if they're going to retaliate or not. That feeds into what ultimately is in the contours of these trade deals that the Trump administration might be seeking to come to. But I don't think that's going to be the outcome for every country. There is some that can't really offer much kind of right off the bat. So, for example, we think of a trading partner like Vietnam, which runs a surplus against the U.S. They can't really purchase more U.S. goods. They're in a very difficult position vis-a-vis the kind of China rerouting question, which is the finding of a Commerce Department investigation from a couple of years ago. So we just see a tougher path there. I think kind of net-net where this leaves us is with uneven tariff implementation on certain countries and even maybe on a products level, right? So what we think is the administration's objectives still are twofold. The administration still wants to use tariffs as a negotiation tactic. In our view, that's kind of been evident with trading partners like Mexico and Canada, maybe to a certain extent some of the other trading partners that we've heard about, like the EU, for example. But Trump is also serious about rewiring global trade based on this premise of reciprocity. And so that makes us think that some of these tariffs actually might be on for a longer period of time than I think investors initially anticipated, kind of heading into not even April 2nd, but this year. That was kind of the consensus view before Trump took office, and the view that we kind of pushed back against, because I think to a certain extent we should just kind of settle in for some higher tariffs for a longer period of time from here. But again, very kind of low conviction on the path forward. It's still very fluid. We're still kind of parsing the legal text to understand exactly what's in scope for these tariffs. So a lot to kind of continue to be discovered over the next few days here. I'll pause it there.
Thank you, Ariana. We will come back to questions once we've gone through all our speakers. So we'll move on to Chris Metley from our QDS team. Chris, what are your views on positioning, flow expectations, and where do you expect the market to go from here, especially given NFP tonight?
Great, thanks. Maybe I'll start with our general views. Look, I think that despite the magnitude of the sell-off, this isn't necessarily a clearing event at the market level. There's still way too many questions on the duration of tariffs, impact on inflation, margins, Fed policy. I mean, never mind the impact on consumer confidence and corporate confidence and spending. Now, I think as a result, we're likely in at the equity level, or U.S. equities at least, for a choppy move lower that is really going to take time to play out. I think particularly given the potential for the stagflationary impulse here that could keep the Fed on the sidelines for longer than they otherwise might be if there's a growth slowdown. We think that means rally should be sold. I think quality works. I'm more optimistic on tech, at least relative to cyclicals, and would favor either hedging at the market level with put spread collars or the Morgan Stanley grind lower strategy, which is MSCBGLE1. Let me just talk a little bit about price action today. Look, this was kind of a 2 to 4 standard deviation event across markets, looking back over the last 30 or 40 years. Yields moved a little bit less, probably a 2 standard deviation event in our estimates versus equities and oil and dollar, which are more like a 4 standard deviation move. Again, I think that kind of reflects some of the cross currents at the fixed income level between the growth and inflation side of things. Look, the equity sell-off kind of got worse as we went through the day. Des did see kind of building long-only supply, definitely concerns over the FX impact and potential repatriation of flows. If we look by instrument, we actually estimate that futures were slightly net bought on the day, and more volume really came through in cash, and that's where we estimate there was a lot of selling. That selling was more led at the institutional level, though, where we estimate flows were in the 6th percentile compared to history. If you look at retail flows, though, this was one of the biggest buy days that we have measured in the last 10 years. So I had some skepticism coming into this that retail was really going to be an aggressive dip buyer because, at least at this point during the year, they normally are backing off. They haven't generally been a huge dip buyer, but today they reverted to kind of their old behavior from a few years ago, and they came in pretty heavily. But at the end of the day, it clearly wasn't enough to matter. Retail as a percent of volume was only 9%. That's the lowest that we've measured in a year. It was a lot more institutionally driven. We also had certainly some impact of systematic strategies and deleveraging from the lever ETFs and the short gamma flow there. Coming into the last trading session, dealers in the options market were basically flat gamma. So there was really none of the usual vol compression support in a down market that we would see from options. Levered ETFs had about $6 billion to sell for every 1% move in S&P. We estimate that levered ETFs sold about $26 billion in U.S. equities today. That is a new record. Price action was also pretty rotational, actually. Again, I think that's probably somewhat tied to the move in fixed income and the fact that we got a little relief from bonds. I'll talk more about some of the thematics in a little bit. But that high degree of dispersion and kind of defensive rotation did make kind of price action during the day relatively orderly, right? It wasn't a super high correlation, really violent move. That, again, kind of tying back to the key impacts here from a fundamental perspective, if this does turn out to be more stagflationary and that kind of changes the dynamic of how fixed income is going to trade, right, then I think that actually filters through into equities in a very different way, because that is what would end up taking correlation higher, because everything in the equity market then ends up going lower, and you don't really have the defensive safe haven bid. Right now, correlation between equities as implied by the options market is still only in the 25th percentile versus history. So if that does change, it's got plenty of room to rise, and that's one of the key things we're looking for going forward, just to see how maybe violent this gets. Just talking about some of the positioning. Like our general view here is that the faster money positioning is relatively light. That doesn't mean that the market can't go lower. It just means that the edge is off, that it's likely to go lower at a little bit more of a choppier or grinding fashion. Hedge fund exposure is coming into today. We're at 46% nets. They're likely down to, if I had to guess, probably 41, maybe 42% after today. Could even be a hair lower. Right, that's going to put them in basically the bottom decile versus history. Macro systematic, vol target, CTA, et cetera. We estimate that positioning there is in about the 25th percentile versus history, and that's going to be going lower. So even though they came into this relatively lightly positioned, 5% day is going to catalyze more supply. We're estimating about 85 billion to sell over the next few days. That's a 3.5 Z-score amount of supply. That is going to make it hard for any real sustainable rally, we think. The good thing, though, is, look, from a U.S. equity perspective, CTAs are already net short, and they're going to be even shorter. You're going to have vol target funds that have largely de-risked at that point. CTAs are longer in Europe, so it's not necessarily quite as clean globally. But then the slower money communities, retail being one of them, right? Retail, we estimate exposure to equities is still in the 75th percentile. If you go at asset manager exposures and futures, that's still the 75th percentile. So there still is length that could come out of the market, but it's going to come a little bit more slowly. And just last thing on positioning, vol. VIX didn't really react to all that outsized moves today. Moved 8.5 points versus 5% decline in S&P. That's a 1.75 ratio. That's pretty typical that you'd see for kind of a normal reaction. So no real vol squeeze. Again, we think that continues. The vol positioning is much cleaner than it was last year. There's really no potential for a short squeeze in Vega, and so don't necessarily going out like advocating buying outright options here. Right, would prefer things short vol strategies like put spread collars, or that grind lower strategy that I mentioned, which goes and buys replicated puts rather than buying outright puts. I think is a better, a more effective hedging mechanism. And this is the last comment from me before I pass it off to Kunal, but look, are we fully priced for a recession yet? Kind of just a simple comparison to recent growth slowdowns and recessions would suggest no. The S&P at this stage, peak to trough, has only moved about 55% as much as you'd normally see if we really do go into a recession or even just a more severe growth slowdown. That recession pricing isn't necessarily even across different sectors and themes. One basket that we like on the back of that is MSXX. RCYC, which is recession-exposed cyclicals that we do think can have some more downside. I'll leave it there. Thank you.
Thank you, Chris. We'll move on to Kunal Sodha from our U.S. Thematics and Market Technicals team. Kunal, can you share a bit more on what you observed on the factors, sector rotations today, and then what are you thinking in terms of positioning going forward?
Yeah, sure. Look, I think from a factor and thematic perspective, I think what was pretty violent and pretty outstanding today was the move in cyclicals versus defensives. That pair, which is MSVV, CYDE, was down 12.5%, which is the most since 2010. And pure beta, which is one of the QIS pure kind of pure beta indices, which is built using the Barra factor model. This was down 7%. Again, this is actually the most since we actually created that index in 2015. And I think, look, this clearly reflects a couple of things. One, where de-risking occurred, which was on, obviously people cutting beta as a risk parameter. I think that kind of relates well with what Chris was talking about in terms of still relatively high net length from the asset management community. But also, I think the cyclical versus defensive underperformance here also to us reflects the positioning that PB Content have been flagging. If you just look at the high beta cyclicals basket on its own, what was pretty shocking really, if you look at that chart, it was in the note we sent around earlier, is it's still on the high since 2020. And I think when you actually dig into the industry groups with our colleagues in PB Content, what you'll find is really it's kind of concentrated within the airlines and the retail sector. So obviously tariffs hitting that most directly and seeing, some very outsized single stock moves, I think did indeed relate to still some sticky high hedge fund positioning in that space. I think points to note in terms of things to look forward to from here. I agree with what Chris is flagging in terms of the specific sectors where recession hasn't yet been priced as extreme as maybe the index or some of the other sectors. So captured in that MS, XX, RC, YC basket, basically 4 out of the 5 the largest weights in there from an industry group weighting still have seen drawdowns on the last 6 months. And when you kind of compare that to what you typically expect in a recessional growth scare, those relative drawdowns are still light compared to even the S&P and some of the other sectors that have been hit, like semiconductors. So I think that's something interesting for clients to dig into. I think from a macro perspective, as Chris mentioned, obviously payroll is pretty important tomorrow. I think 2 things to note there. I think our conversations with clients in the US generally point to them about that. I think payroll is quite asymmetrically set up for tomorrow. I think a bad print will be taken only to accelerate the de-risking from a recessionary context. I think a good print will be probably looked over as being potentially still too early to tell before the hard data rolls. I think 11:25 a.m. Eastern tomorrow on Friday is very important. Chair Powell will be speaking. So our first opportunity to really hear his take, not just on payrolls, but also on the tariffs we've seen. And I think with that in mind, CPI the week after is super important. So just lastly from me, from a tactical hedging perspective, I'm of the view actually that potentially the next leg down could occur if you actually end up with a positive CPI print, i.e. a more, a hotter print than expected. I think higher rates could be the catalyst for the next leg lower. So with that in mind, we quite like here June 25 dual digitals, which is basically looking at S&P 5% lower and 2-year yields on the forward basis, on the swap basis, 25 basis points or higher, and that solves for a 10-to-1 payout. I think the rate equity correlation is still pretty unstable, and I think people are very nervous about the inflationary impacts of tariffs and when that could pass through. I'll pause there. Thank you.
Thanks, Kunal. And before we move to our final speaker, just a reminder, if you have questions, please do write them out in the Ask a Question box. So moving on to Eli Hulse from our U.S. Equity Derivative Sales team. Eli, can you share how clients were thinking about this going into Liberation Day, views yesterday on the back of what we saw in the market, and then just what you're seeing interest in from a positioning and hedging perspective?
Yeah, definitely. Thank you, Afshan. So I think this is a relatively well-known risk event. I don't think that anyone was, kind of taken by surprise that it was coming up. And because of that, we've had lots of conversations over the last 2 weeks about ways to hedge, this tail scenario from long only to long short hedge funds. We've seen, net leverage come down. We've had a ton of hedging flows on our desk over the last 2 weeks. clients buying IWM put spreads, S&P put spreads, puts. We traded a ton of dual digitals, those the trades that Kunal was talking, in the form of S&P lower, gold higher, S&P lower, yields lower, things that, are exactly meant for this type of scenario. So when I talk to clients kind of across the street, I think our view is that most of them were relatively well hedged, at least from like the long short community going into this event. And Melly kind of touched on it. I think that we saw that similarly in the flows today. Institutions were probably net flat to buyers. Retail was buying. We saw futures being bought. Probably a lot of that's covering hedges that were on there already. The big supply came from long-onlys, which I think kind of speaks to that. Equities down, dollar down, which is kind of the pain trade for any foreign long-only investor. So I think given that, most of the long-short community was relatively well hedged, that kind of explains some of the flow that we saw today on the derivative side. The majority was people rolling down put spreads, unwinding puts, unwinding hedges. There wasn't as much chase for upside. We had a few clients put on upside in, core fundamental positioning and core fundamental positions. But that was relatively small. The depth overall was delta to buy, but that was just from people unwinding or rolling down hedges. I do think that some of the roll downs were pretty extreme. Coming into the morning, we had large sellers of S&P put spreads, very wingy, just kind of rolling down those strikes. And I think that tells you that people are still worried about continued move lower, but maybe are just, kind of adding a little bit of delta back now that the event has passed. On a look-forward basis, I tend to agree with Kunal. I think that there could continue to be continued weakness, especially if we are getting, into a more prolonged growth slowdown. So things like S&P lower, yields higher. If the Fed has to, Morgan Stanley just published our rate outlook, forecasting 0 cuts this year. So if we get kind of that stagflationary environment, I think that could make a lot of sense and perform well. And that grind lower strategy, we kind of feel like we're in a 2022 type environment where we have a growth slowdown in 2022 is caused by rates. This seems to be caused by tariffs and input cost increases. But we're not seeing vol explode. And Melly touched on this briefly, but the vol positioning is very clean relative to some of the historical moments where vol really exploded. Thinking like 2018 and the taper tantrum or 2020. So I think it is probably unlikely that we get a real large move in vol from here. I think vol on a beta adjusted basis, like looking at VIX versus spot, was relatively in line today. And I think that just kind of speaks to the lack of panic that you saw from investors in putting on hedges, even though the market was down that 4.5-5% today over the day. So I'll leave it there.
Thanks, Eli. We'll start with some of the questions we've received. So Ariana, let me start with you. Can you talk a bit about what these tariffs could mean, not just the U.S. growth outlook, but actually globally?
Yeah, sure. So, of course, we've kind of hit on the economic outlook here in the U.S., so I'm not going to go through that again. But one of the main kind of key points there is just that this uncertainty really will continue to weigh on the outlook. To Eli's point, you just mentioned again the Fed cut taken out from this year, but really the extent of downside from here is going to be a function of, like I said before, how long these tariffs are in place and how broad they are. Just kind of hitting on the different regions. In Europe, our economists kind of most frequently pointed to rule of thumb is that this permanent 20% universal increase of U.S. tariffs on EU goods, now assuming that's universal and permanent and stays in place, all else equal, would reduce the euro area GDP by a range of 60 to 120 basis points. So the 60 basis points, the lower end of that range, reflects just the direct trade impacts, and then the upper range, the 120 basis points, adds in the impact, again, of uncertainty and financial tension. And then, interestingly, in Asia, our team led by Chen Nayat over there thinks that this is probably one of the most exposed regions, just given that most of these countries run a trade surplus with the U.S., and that's a really key metric for the Trump administration. We saw that the reciprocal tariffs are largely a function of the trade deficit in goods. And so that's, like I said before, the trade deals are going to be kind of the key indicator here. And that means that each country's ability to negotiate trade deals will be the key determinant of their outlook. So inside that framework, we think that India, Japan, Korea, and Indonesia are most likely to get a trade deal done, while on the other hand, kind of the worst positioned on both the extent of the tariff increase as well as the ability to get a deal done would be China and Vietnam. Just tonight, I saw a headline come across that Vietnam is asking the U.S. to kind of wait on a position and then start negotiations. But I do think that kind of syncs up with our view as well, that it's going to be a difficult starting point for them.
Thanks, Ariana. Chris, just moving on to you. Retail, you mentioned, was buying, which was unexpected. So how are you thinking about retail activity going forward? And could we view this to provide some level of buffer against selling?
Sure. I mean, look, if retail does somehow maintain this level of buying, which we estimate was about $10 billion today, sure. I mean, it can definitely provide some support to the downside, or even catalyze upside moves. I mean, I think retail was particularly impactful at several points already this year. Post inauguration, they were driving the rally. I think that in late February, when they pulled back, they really contributed to the sell-off. So they can be a driver. But I have my doubts whether they're going to be able to sustain this level of demand. Right? If you zoom out from just day-to-day flows and look at the big picture, retail activity typically mirrors economic activity. Right? So if we are going into a growth slowdown, if we see employment fall, if we see earnings contract as well, and these are all things that tend to be correlated with the level of retail demand. And so I don't necessarily think that retail flows will be counter-cyclical to the equity move, at least on a sustained basis.
Thank you. Thanks, Chris. And then let's go to Kunal. So Kunal, can you touch a little bit on the Fed? I know Michael Gappin updated his outlook, and we do not expect any cuts. The question we have is, what will the Fed need to see to cut rates?
Hey, yeah, look, I mean, it's a really tricky setup right now from a Fed perspective. And I think what's interesting is, I guess if you kind of mechanically apply and pass through the effect of tariffs, what you find and what Michael and team have modeled really is the fact that you get first the inflationary impact, and then at a later stage, I guess, derived from the 2018 experience as well, it's kind of like a 2 to 3 quarter lag before the growth impact really kind of comes through. Now, bearing in mind that the 2018 situation was pretty much in isolation and actually was on the back of a tax stimulus. Now you have, several other sort of forces at play, immigration policy, which is a growth dampener, and then the potential for tax cuts and extension of the TCJA, which could be a growth stimulant. So I think the mix and the cocktail of different policies that the Fed has to manage makes it extremely delicate and complicated. Now, with that in mind, I think what is interesting is the market, in terms of the rates market, has shifted to pricing almost 4 cuts between now and the end of this year and a further cut next year. I think why that is interesting is because, from my perspective and conversations with some of our macro clients, is it seems like that might be actually the lower bound for now, i.e. a floor in terms of 4 cuts priced. And I think the reason for that is, even if you do get some weak payroll prints, meaning the traditional sense, the cadence on a monthly basis drops off from, say, 130, 140K, which is what's expected tomorrow, to, say, 50K, the issue and with that is the unemployment rate may or may not actually move significantly higher. So to put that in context, the last payroll print, it was a 4.1% unemployment rate, but if you had adjusted for labor force participation, it had shifted down, it would have been 4.4. And obviously the Fed cares deeply about the unemployment rate. So the tricky thing for the Fed is the monthly cadence may drop, but the break even on a monthly basis to keep the unemployment rate constant may also drop, which means they may not get a signal from the labor market that they actually need to do anything. So which is why I think the pitch I was making at the top of the call is pretty relevant, because if you have a Fed that's kind of stuck, but you do know the inflation impulse is going to be pretty notable, I just don't think that's a cocktail the equity market can cope with. So I do think it all kind of comes down to maybe the next phase is some of those cuts might get forced to price out, but not for good reasons, not for growth reasons, maybe from an inflation perspective.
Thank you. That was very useful. Ariana, we'll go back to you. We've just got a question on how should we think about expectations from a retaliatory perspective? What kind of retaliation would we expect?
Yeah, so again, I think thus far the reaction has been pretty muted. We got some signals ahead of April 2nd in terms of what countries might retaliate with. So far, the ones that we've really seen follow through is Canada. But again, that's not new news. It was what they had announced kind of prior. They just planned the implementation for April 2nd or April 3rd, right? So in response to the Trump tariffs. I think when it comes to other trading partners, China actually kind of digested that first round of tariffs. They imposed about 15% on certain imports from the U.S. And then in March, they kind of announced another additional 15% on other imports. But the real mechanism for response hasn't been through trade escalation. That could change. We've seen kind of resorting back to the 2018-2019 playbook as well, with filing complaints of the WTO. That was kind of Europe's move as well with the first round of trade negotiations. So I think thus far we haven't really seen much crystallize. China said they're going to take countermeasures. We haven't seen those come to fruition yet. The EU is kind of the big question mark, because they initially said they would put tariffs on response to U.S. goods with sort of a scheduled laddered implementation, but we haven't heard enough detail on that yet for it to really be credible. And then I think, in the other countries, they've signaled an intent to negotiate and bring down either scheduled tariff increases or to start those bilateral negotiations. So we're just going to have to wait and see what these governments come back with. But thus far, like I said before, it's been muted across the board, I would say, except for a few examples.
Thank you. And then, Kunal, Chris, one for you. What is the biggest upside and downside risk on a going forward basis?
Yeah,
Kunal,
sure. I'll kick off with, happy to kick off, and then I'll pass to Chris. I'll comment on the macro side, Chris, on the positioning setup. I think from a macro side, I guess as I mentioned just now, I think the downside risks are centered around, I'd say, more things than the upside risk. I think it could be a faster than expected deterioration in the labor market. Whilst you will obviously see more rate cuts priced in, that is obviously inherently bad for risk assets in general. And I think then you get credit widening, and I think more credit widening, and I think you get more of this, what we've seen today, which is cyclicals underperforming, broad de-risking. And I think the consequence of that in particular is actually worse from a global perspective. I think then maybe some of the outperformance we've seen in the other regions may start to give back as well. So I think that's obviously not a great outcome. I think on the upside, though, I think if you have some fairly inline labor data, I think clearly, the ISM data has not been great, but if the rest of the hard data kind of hangs in there, and you get progress on the tax cuts, the tax bill, which, if needed, Ariana can speak to later, then I think that will be viewed as pretty inflationary, so reflationary. So I think that could be taken quite well. But I'll hand over to Chris from a positioning perspective.
Yeah, I mean, just from near-term positioning, look, I think the sentiment is squarely negative on the medium term. I do worry that a lot of people are looking for the bounce that you typically get after one of these sharp sell-offs to initiate more shorts. That may make it a little bit more challenging to actually get that bounce. I think that consensus or most conversations I've had over payrolls are saying like even a good number given the tariff news that we've had isn't really enough to get people too excited, plus expectations that growth will slow in the future. Impact of federal workforce cutbacks will not manifest itself just yet. So I think it's going to be hard to get too many people to really get behind any type of rally and really drive it. You would need materially good NFP print, I think, to really change that. If you did get something, could that catalyze a short squeeze? I mean, definitely. Right. You're going to have nets in the low 40s. The thing we didn't talk about was the fact that gross leverage for hedge funds still remains incredibly high. It's over 200%, 95th percentile plus. High gross, low net, what does that mean? That means that the short leverage is also incredibly high. It doesn't necessarily, I don't think that this level of short exposure is as crowded as it has been at various points in the past, or at least not quite as concentrated. Short book is a little bit more diversified, but still, that doesn't mean that you can't get a short squeeze. It could be quite large in index products, and it would be the one, I think, defining feature probably across the short book that would be at risk would be low quality. Right? That is where a lot of the shorts really across different sectors are quite concentrated. Like on the downside, from a positioning perspective, I think it's probably a little bit less acute. Like I mentioned, we've got the slower money, whereas the real equity length is. But at the end of the day, I think the biggest thing that could really shift on the downside that would potentially bring some of that supply forward, positioning-wise, would be correlation. Right? If we really do get shift in market structure to a more highly correlated market where there's less winners and losers from tariffs, there's less of a defensive rotation, then that's when things can get particularly problematic from an asset allocation perspective and bring in more supply, or disorderly moves in the dollar. Right, that has been one of the things that I think the general views are that repatriation out of the U.S. Into the rest of the world is going to occur, given the moves we've already had. If those moves get much more violent, it could bring forward some of that the selling in U.S. equities to pull it back into the rest of the world.
Thank you, Chris. Thanks, Kunal. Thanks, Ariana, and thanks, Eli. We'll wrap this up now. If you are not seeing content from Kunal, Chris, do let us know. And if you have any follow-up questions, please do reach out. Actually, guys, we have one last question. Maybe we can take that. VIX and volatility is not moving as high. Is it due to a lack of panic or any technical reasons?
Both. I think that the fact that hedge fund nets were already sub 20th percentile coming into this, means that people were, relatively well hedged. Right? As I mentioned, we had a lot of hedge roll downs and to just kind of manage hedge portfolios as today evolved. There was not really a ton of panic. Price action during the day obviously was a bad day, but pretty orderly, all things considered. So yes, part of it. But I think the biggest thing is that dealers are not short downside options. They're not short downside Vega anymore. If we go back to August 5th of last year, the VIX spiked to 65. That was driven by dealers being short downside Vega. Just the way we usually measure this is slide risk. We say, all right, well, if the S&P were to just gap down 10%, how much vol would the street need to buy? A year ago, that was 200 million Vega. Now it's 20 million Vega. Right? It's only 10% as big as it was last year. So there's really just no squeeze potential in vol. And you've seen that play out in recent days, and I think that's what you're going to continue to see going forward. Doesn't mean that VIX doesn't rise in a down market, but you're not going to see it move more than, it's kind of typical beta, which is 1.5 to 2x points in VIX per percent move in S&P.
Got it. Thank you, Kunal. All right. Thanks, everyone. Good luck. And if you have any questions or if you're not receiving content from us, let us know. And any follow-up questions, please reach out to your sales representative or any of us on the webcast. Thanks, everyone. Goodbye.